Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined by Dynes and Nicol Dynes. Nicol, what's your pick of the stories this week?
Real Asset Media held another of its infrastructure summit. This one was devoted to energy. And there was consensus that the massive transformation that's taking place in the energy sector is going to create huge opportunities for investors at all levels. It's a multi-decade process, but it's got two very strong parallel drivers. One, obviously, is regulation, governments and regulators. They're driving investments in energy transition, but clearly the policy element is very important because there's a global consensus for the very first time. Now, the US are on board as well, and China. Everyone is basically going in the same direction. But the other very strong driver is the fact that it's getting cheaper. So there's an economic incentive as well. And then they were saying that even in the US, in the Trump era, which was certainly very hostile to the renewables, solar and wind energy prices went down by 12%. The problem they said with investment is that there's a lot to be done, but obviously people can make mistakes. It's a huge sector. You have to know what you're doing. But on the other hand, if we're going to go anywhere near the very ambitious target that everyone is setting, companies and governments alike, then the investment are so huge, so many billions, that opportunity will arise. And Thomas Byth of PwC said that at the moment, there are also opportunities for investors at very different levels. For example, he said that venture capital can target returns or 20%. In the development phase, that in the commercial viability phase, more of a play for private equity, and they can target return for 15 to 20%. While in the third sort of mature phase, the sort of infrastructure investors can target return to 5 to 10%. So basically, there's something for everyone. As I was saying, it's a sort of decade-long play. So very interesting sector to watch. Another Real Asset Media summit we had this week was on H2, the outlook for the sector. And there was consensus that things are looking pretty good. Investors are regaining their confidence, and there's a lot of capital, as we said many times, waiting on the sidelines. And obviously, as things get better with the vaccination program, as investors are able to travel, the UK market in particular has been penalized because it's very much an international market. The fact that investors are not able to travel and come and see assets obviously has not helped. But all that is changing. The UK has had a bad recession, but it's also very ahead in the vaccination program. So there seemed to be optimism and a lot of interest coming back. And someone was saying actually in 2020, the only foreign investors that really traveled that still did deals were the South Koreans. One thing that is definitely happening is that there's a polarization around sectors. So residential and logistics are very much in demand, which is obviously creating pressure on prices. Prices are very high and it's very difficult to make returns. So investors who want to look beyond resi and logistics to try and find better returns have to be a bit brave and look at the retail sector, even though, as we know, it has not been flavor of the month for a long time. But, our experts said that you can definitely find opportunities because many segments you can look at and there are opportunities to be had. And there was quite a lively discussion around offices, like a big question mark. And there seemed to be disagreement with our experts between whether the future office is in regional hubs, because some people will work from home a couple of days a week, but will not want to travel far, or whether they'll be back to the big headquarters, shiny headquarters in the city centre, because especially young people want to have that buzz of the city centre, and whether the urbanization trend will continue. But everyone agreed that belief in retail and the office and the future of the office is very much linked to belief in the city. If you believe that people will go back to the city centre because of that buzz I was mentioning, because of all the good things that the city can bring, then there will have to be retail, there will have to be a high street, there will have to be offices. But on the whole, a feeling that 2021 has started on a very good note. The 2020 wasn't as bad as feared for a start, and the 2021 has been even better.
Yes, it was interesting. I thought that overall feeling of the fears about what could have happened in 2020 didn't, and there was a much more positive outlook coming into 2021. And as vaccinations come through, certainly going through the second half of 2021. And as well, this week there are a couple of stories that reflected some of the themes we discussed in that outlook session with logistics specialist GLP alongside partners Canadian Pension Plan Investment Board Europe and Quadreal Property Group, increasing the size and scope of their fund to 4 billion, so doubling it to 4 billion in order to target UK and CE markets. And GLP Managing Director of Fund Management Ralph Wessel said, "Our investment pipeline is considerably ahead of schedule and we're seeing strong demand for our developments." And in the alternative space, data centre provider Global Technical Realty is set to establish a major data centre campus in Slough, following an agreement with Segro. GTR, which is backed by US-based investor KKR, plans to operate bespoke data centres for high-growth global technology companies. And CEO Franek Sodovichny said the data center space is moving fast, and we're delighted that the UK will become home to our flagship concept. And I noticed as well on residential, which was a key point that came up, the new Future Living report from Investec Real Estate predicts a golden age for UK resi for rent. As the United Kingdom's recovery from COVID-19 picks up pace, we expect to see growing appetite for nationwide investment in the sector, according to Mark Bladen, head of real estate at Investec. So a lot of those trends coming together, and resi's still a very, very strong trend there. Dan, what have you been following?
Well, I mean, I couldn't agree more about the residential theme there, Richard. This week has been very busy again with that build to rent sector. In fact, in the UK, Landsec and British Land, for the last 2 decades, they focused on office space and retail. They're making their moves again into build to rent. You know, we've talked a lot about the repurposing of retail space and the move into residential, but both have announced plans last week to develop large mixed-use projects, you know, rather than focusing on those traditional asset classes. And, you know, BL is developing the second phase of its Aldgate project, which is going to include 159 premium build-to-rent homes. And let's not forget that there are many different strata within that build-to-rent sandwich, so to speak, of, you know, premium down to sort of accessible, more affordable homes at the sort of student housing end. But British Land, you know, they're also going to be building between 2,000 and 4,000 homes as part of a flexible consent that they've secured at Canada Water, which is its fourth London campus. And Landsec, in sort of very interesting in that repurposing space, their move into the rented resi sector is part of a redevelopment of its London shopping centre, the O2 in Finchley, northwest London. Again, you know, repurposing an entire shopping centre towards resi. It's all really backed up. As you said, there's been several reports and pieces of research, Richard, and one most recently as well from Cushman & Wakefield. It suggests that European build-to-rent markets, they're ripe for rapid growth and investment, especially in capital cities. It's been acknowledged for some time now that, you know, the UK is set to become a nation of renters. You know, this whole phrase of generation rent, and investors are beginning to start cashing in on that. In major European retail news, in Paris, LVMH are opening an $894 million luxury shopping destination in Paris. And it's the redevelopment of La Samaritaine, which of course is the 19th century beautiful Parisian landmark. I mean, it's been brought out of hibernation and resurrected into this incredible looking dining, shopping and sort of tourist destination. It was going to be part department store, part hotel, and that restoration, you know, is one of the most anticipated openings this year. And even French President, you know, Emmanuel Macron called it a wonderful French treasure. So when the Samaritaine opens on Wednesday, for the first time since it last closed in 2005, it's going to be one of the newest luxury department store offerings on the Parisian landscape. And in retail developments closer to home, Selfridges, the department store in London, they've launched a garden centre, not just in London, but also in Manchester and in Birmingham. And it's really capitalising on that pandemic driven gardening boom. But not what you'd expect from a luxury department store, but they're going to sell everything that you need: tools, seeds, indoor, outdoor plants, even its own compost. So expect to see people carrying bags of compost down Oxford Street sometime soon, Richard.
Great, very good, Dan. One of the good news stories that I saw, the Trish Barragan Scholarship Fund, which had been founded by Audrey Klein, Laura Coleman and Matilda Williams in memory of Trish, had raised over $250,000 in only 6 months, which, as Laura Coleman mentioned on LinkedIn, is a real testament to Trish's influence in the industry. So great to see that amount of money being raised in that amount of time for such a good cause. Thank you, Dan. Thank you, Nicole. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the key themes in the real asset markets.